Okay, so welcome everybody. We are live. We're just waiting for some people to jump on here. This is my name's Sam Abdallah with Affluence Real Estate Group. We are here with Sai Lee today from Mortgage Guys. And Sai's going to introduce himself, a very reputable, exceptional mortgage broker, understands the industry very well. And today we're going to speak about all your questions on Q&A as far as mortgage rates. He's got some great points here, maybe even a case study, and just things that you need to think about. And if you have questions, please put them in the chat. We have our admin moderating this call, and we have our Calendly link. So if you'd like to book a call with Sai for individual questions and things like that, feel free to do so. Go ahead, Sai.
Sure. Awesome. Thanks for having me here, Sam. So I just want to introduce myself. I am a mortgage agent, work for a company called mortgageguys.com. And in the last 8 years, I've been involved in personally investing in real estate, mortgages. I'm not a licensed real estate agent, by the way. That's all, Sam. My focus is helping people get the financing. And I just want to put this out there because I do get a lot of questions, especially from first-time home buyers of exactly, what do mortgage agents do? So what we do is we connect you with the banks, and our job is to find you the right solution that's a good fit for you. I mean, just based on your current situation, what your financial goals are, what your investing goals are long term. And we also connect you with banks that you're already familiar with, like TD Bank, Scotiabank. So just wanted to put it out there, just make it clear for everybody that, yeah, that's what we ultimately do. Do you have any questions at all, Sam, that are very specific in terms of anything that you've been getting from your clients in the last couple of weeks?
Yeah, let's just start with this one. I mean, Sai, why is it important that someone works with a broker rather than just a big bank, or at least goes to the branch?
Yeah, that's a good question. It's just like I said, we got access to lenders, big banks, we got credit unions, we've got subprime lenders. It's important because you see, our job is just to find you the right fit. And sometimes going to one bank might not be your best option because you go to one bank, well, guess what? You're getting basically two products. You get fixed, variable, and it's the bank's guidelines. Um, if it didn't fit with the bank, then you're just wasting a lot of time because you're going to be having to do the whole process all over again with a new bank, right? You have to reapply with a new application, give the bank all new documents again. With us, it's really like a one-stop shop. It's one application, one credit pull, and you have access to pretty much all the banks. It's just way more efficient.
And Sai, what are you noticing right now is the biggest concern of how the mortgage rates increased previously and the upcoming rates are affecting real estate affordability, as well as just in general the real estate market, but affordability mainly?
Yeah, and you know what? That's a good question. I don't know if people know this, but it is definitely going to make an impact on qualifying. And so what I'm going to do is I'm going to just go through a couple numbers here. And it's important because this is definitely going to determine your buying power going forward. Okay. So just so everybody understands, like when you qualify for a mortgage, you're qualifying for what's called, the bank is using something called a stress test. They got different names for it as well. They call it a qualifying rate. And for the longest time, even up till today, like that qualifying rate is 5.25%. So when you qualify for a mortgage, the Canadian government is basically saying you need to qualify one of the higher of the two, either at 5.25% or the contract rate plus 2%. Okay, now this is where it gets interesting because if you were looking in the market today and you're going to be buying a home, and let's just say that, you are fixed on just getting a fixed rate mortgage. Okay, we all know that right now, fixed rate mortgages are closer to about 4%. And so if you were going to pay 4% on your mortgage, well, like I said, the rule is either contract rate plus two, the higher of the two, or stress test. So that means if your contract rate was 4%, well, that means you have to qualify at 4% plus two, which is 6%. Okay. And this is important to note because when the stress test, this qualifying rate increases, it means that any borrower going forward is going to qualify for less, right? I love my math. I love my numbers, Sam? So I'll give you a perfect example, okay? Let's just say that you had $100,000 of income and you can qualify at 5.25% stress test, 5% down, no debt. Let's keep the numbers very simple, okay? You would qualify for a $500,000 purchase. Now, going forward, if you wanted to go with fixed rate of like 4% plus two, right, we're going to stress test the mortgage now at 6%, same income, $100,000 down. I mean, $100,000 income, 5%, $25,000 down. You would now qualify for $450,000, which is crazy, right? It means 10%. That's a 10% drop in purchasing power. So how do we get around that? Well, you know what, going forward, you might have to take the variable, right? Until variable gets past that 3.2, 3.25. Okay. Right now, variable is still under 3.25. So it's not going to hurt anybody going forward if they're going to go with variable.
Okay, that's a great point. And I know in 2017, when we had a bit of a change in market, we had a stress test increase. I think you were aware of that as well. How is that a little bit different, or is it similar now what we had in 2017 when we had the stress test increase and less buyers could buy a certain priced home?
That's right. So initially, I just want to back it up there a little bit. I mean, the whole point of having this stress test in place was that so that if rates ever got up that high to 5.25, right, that you would still be able to afford your mortgage payments, right? The whole point of having the stress test is just to basically say, hey, we are going to qualify you as if you were already paying 5.25%. Right? That's that measure that they put in place to make sure that when you do go get a mortgage, you're not going to be house broke. But in contract, you're going to get something much lower than that. And it's not much difference. It's just that anytime you hear on the news about, hey, you know what? The stress test is increasing. If it increases, then you're going to borrow less. If the stress test is falling and that's decreasing, then it means that you're going to free up buying power.
Understood. So if someone got an approval, let's say before this, maybe 60 days ago, how long is that good for? Does it depend on the lender? What can that person do to purchase now? And how does that affect that particular buyer or seller?
Yeah, so it really depends on lender. So every lender, because we work with, oh gosh, maybe over 15 different prime lenders, okay, with best rates on the market and stuff. Every single lender has their own little nuances on rate holds. Like I gave perfect example. Some lenders, they only like doing rate holds on fixed rate mortgages. Some lenders won't give you the best rate hold up front because they're hedging their bets. It's kind of a complicated question to ask because there's just so much variances of it. All you can do is that, look, at the end of the day, when you buy, I can promise you that when you buy and you have something in contract, that's when we can negotiate the best rates for you.
Understood. And I think that's important with your calendar in the chat there, as far as booking a call about their individual situation. If you have a specific situation, what that would be like for you. Tell us a little bit about your process when you have someone that's booking a call with you. What do you do to uncover their goals and to help them navigate what's going to be the best financial decision for them, whether they take out money, pay off some debt, do a renovation, or look at maybe if they're looking to upsize, for example?
Yeah, for sure. I mean, you know what? I'm so used to my numbers. It's just my process is pretty straightforward. I'm just so used to seeing pretty much all the same numbers all the time. And so what we do is, I'm a pretty efficient mortgage broker. We just get on a quick call. I don't want to waste your time having to get dressed and drive all the way to the bank and take time off your work. Look, we do a quick call, 15, 20 minutes. Within that 15, 20 minutes of me just asking you a few questions, I'll have about a pretty 90, 95% good idea of exactly what you're going to qualify for. Okay. It's just math at the end of the day. That's what mortgage is all about. I don't like wasting people's time. I don't want to take you through this entire process just to give you a number that you're not happy about, or just to tell you that, hey, you don't qualify. Within 15, 20 minutes, we're pretty much going to be determined, if you're going to be able to reach your goal of either purchasing, refinancing, whatever that is. And then after that, it's just pretty simple. It's online application. We collect the documents. Okay, everything's done online. And after we collect a full package of documents, I give you a budget sheet to work with. Within the budget, it's pretty straightforward. I let you know exactly what the costs are, like closing costs if you were going to buy, what that looks like, what your down payment looks like, what your payment looks like. Everything's just laid out in the open, because you know what, I'm that kind of mortgage broker. I just don't like surprises. I want everything laid out into a budget sheet. You can clearly see it, so that by the time you do go fund, it's pretty much going to look like that.
Awesome. And to your point as well, what should people look for when they're getting into a rate or a mortgage? It looks like attractive and it's not really what they actually thought of, whether it's the terms or what are things that people should really look for if they're looking to renew or they're going to be refinancing. And I'll ask a question also if they should actually use that to pay off debt as well. Maybe you can speak on that.
Yeah, it's interesting because pre-pandemic, right? A lot of people were leaning towards going like fixed rates, okay, because the two were just kind of neck and neck. During the pandemic, we saw a huge shift in variable. Like I think we were actually more than half of the business in the mortgage market during the pandemic was variable. It was just because the spread was just so significant, and plus the variable just comes with a much lower penalty. So it only makes sense. Why not just save interest from the start, and you don't have this big penalty just lingering over you as well, in case you ever need to make any changes in your life. In terms of refinancing, my gosh, yeah, the refinance business during the pandemic was crazy. Rates were super low. People were consolidating, high interest loans into the mortgage. I mean, at the end of the day, it only makes sense to do so. Especially when rates were as low as like 1%, 1.2. There's no reason why you should be paying 8-9% on unsecured lines of credit or credit cards. Let's put it all into one simple payment.
Okay, gotcha. And what are some of the, I wouldn't say dangers, but the challenges with if someone is really over leveraging that equity? Because I guess if the market has been fairly good, yet at the same time, what are things that you're finding right now that, in the refinance business, what are the common challenges? And what are things that people should consider if they're going to refinance?
Yeah, I mean, when you refinance, I'm a big believer that there's a couple reasons why you should refinance. Either, like a lot of my business last year, I was refinancing people into rates as low as 1%, 1.2. It was crazy. And it's because, you know what, they're sitting on variable rates as high as 2.5%. We pay a 3-month interest penalty. We get you a rate that's pretty much half as much as what you're paying already, which is crazy, right? So that's a good reason to do it. Another good reason why people do it is, like I said, they're just consolidating high interest debt and loans into one simple mortgage payment. But I mean, at the end of the day, it's got to make sense. And my job as a mortgage broker, like I said, this is why I live and die by my budget sheets, is that any single time that you come to me for a mortgage, I got to lay it out for you. I want to show you what your current budget looks like. Hey, here's what your financials look like currently. Let's look at all the payments. Let's look at, what your cash flow looks like. If we were to refinance into one simple mortgage payments, what is your actual savings per month? And then it makes sense because the savings have to outweigh the penalty. Otherwise, I would just gladly tell you upfront, hey, you're crazy. Please don't do this because
I
you're
think
not saving any money.
that's a great point because when you speak about wealth building, it's also reducing expenses, right? And actually
That's
having
right.
more cash flow or more money available
Yeah.
through reducing unnecessary debt. I think that's a great point that you brought up is that you look at the client's individual situation and how that helps. As well as if you anybody ever would like a copy of the net worth tracker, let us know. We'd be happy to look at that with you and in conjunction with Sai. We can also add some value.
Yeah.
Sai, what
And
are
to that point too, Sam, I love real estate investing. Like I'm a real estate investor too, right?
yeah, absolutely.
And even for my investors, it's like, hey, look, if you want to go buy more houses, why do you have these car payments? Let's put them all into the mortgage. Look, I get it. You might got 0% financing or 1% on your car payments. That's cool. I can't compete with that. But having a car payment isn't going to help you going forward if you're going to buy more houses. Let's just put it all into one simple payment. It's going to be way lower than what you got in your car payments, and let's go get you another house.
That's a great point. So, I was listening to on Bankers Vault YouTube channel. They talked about when every time you refinance, you front load that interest, which I guess means that you refinance, you're starting the cycle again, and now interest is kind of on the front end again. Is it still advisable to refinance in certain areas and not to? What should one think about when it comes to that? Because that was an interesting point.
Yeah, it's funny how you say that because that's most people's view of, oh my gosh, I'm gonna take another 30-year mortgage and it's gonna take me 30 more years to pay. That's actually not true. Okay. The amortization really just means the life of the loan. Sure, if you made minimum payments, it will take you 30 years. Okay. But I have yet to meet a client that literally sits on their mortgage and makes the payments for the next 30 years because life changes. They will refinance, they will sell at some point. Okay. Everybody has a different financial and investing plan. Okay, my investors, and even for myself, you know what? Full disclosure, I'm always re-amortizing mine back 30 years. You know why? Because I want to make my monthly liabilities look as low as possible so I can go borrow more money, right? I mean, hey, like I said, everybody's a little bit different. Everybody's like, you know what, Sai, I'm not comfortable with 30 years. I want to pay it off in 15. Cool, we can do that as well. It just means your payments are going to explode. Okay. And even though you're sitting on a 30-year mortgage, the key thing is this is why I say rate is not everything. You need to be placed with lenders that have full features and flexibility, because then you know what it's going to allow you to do? It's going to allow you to double up on your payments, do extra prepayments towards your mortgage. And all of a sudden, 30 years becomes 25, becomes 20 by the time you renew. So full feature is going to always beat rate all day long.
That's a great point. And I think what we'll do is we'll have our admin put in the chat the link to that webinar we did on leveraging your equity to
Yes.
answer the 3 financial questions, and on one of them being pay off your mortgage faster, which is a huge goal for a lot of people. Definitely. We have a question from Moldine here. So
Yep.
will sellers be affected as much as buyers? So Moldine, I think that that's a great question. To chime in a little bit on that, it depends on the price point in the market and the area. Right now we're at about 1 month of inventory, which a balance market is about 6. And if it's a lower priced home and we have people moving in from immigration hub of Toronto and other areas, it's still going to bring demand in real estate here. So I think that that's fairly good. You would have to look at it on a micro level. So if you're in real estate, you'd look at it with your client. If you're a potential buyer or seller, you would look at it with your client individually with their case. And that's probably where booking a call would help. People who are upsizing, the benefit I think is the payments are still fairly good. It just makes sure that you're not going over and above what you can actually afford. And you probably look at paying down some debts, or at least, like Sai said, putting everything in, getting rid of those unnecessary payments. Anything, Sai, that you'd like to add? And what are you finding right now that are the biggest concerns, myths about this whole thing with rate increase previously and upcoming?
Yeah, absolutely. I want to touch base definitely on that, but just to add on to that as well, Sam, in terms of sellers being affected as much, absolutely. I mean, it's going to be the same thing. I mean, hey, if you sell, you're eventually you have to go somewhere. So if you sell and you buy, yes, you have to qualify under new guidelines, under today's rates. You're going to fall under the same rules as any buyers going forward. Okay. In terms of rates, to your question there, I want to touch base a little bit about that. Okay, and like where's this all going exactly? Okay, because that's kind of like the number one question why, and a good reason why my calendar is just filling up like crazy. Okay, so I want to make sure we touch base on this. And what I want people to realize is that more questions are actually being generated out there by the news, right? Me and you both know that, Sam. Then there are answers to, so all we can do as real estate professionals, mortgage professionals, is that we can do is we can do the best that we can do with the information that we have on hand, right? Nobody has a crystal ball. And if you're okay with the fact that, you did the best with what you can, with the information you had on hand at that point in time, you should be fine and you should be happy with that. Anybody that went variable during the pandemic in the last 24 months or whatever, you know what? Congratulations, because you've done very, very well, right? And I've had clients call me in the last, couple of weeks because of the recent Bank of Canada prime rate going up. And they were all, I had some clients thinking, hey, I kind of regret that I didn't go fix at the time. Okay. And I want people to know that you need to always look at the big picture. So just know that rate, like I said before, it's just a small part of the mortgage. And in my opinion, it's just a small bet. It's not the big bet. And what I mean by that is that, really understanding what really goes on a mortgage is key to saving you money in the long term. And that, and it really is this, the big bet is that being in the industry myself, okay, 2 out of 3 people, these are the statistics. 2 out of 3 people will break their mortgage on an average of 36 months, right? That's 65% of borrowers. I know, I get it. You know what? A lot of people, they've told me many, many times, this is not going to apply to them. But this is a true statistic, folks. It's not on Google. The big banks, they keep statistics of all this stuff. big mortgage insurance companies like CMAC, Genworth, they used to call them Genworth, Sagen now, it's called Sagen now. They keep statistics of this. 2 out of 3 people will break this. And why is this important? Because when you trigger the penalty on a fixed rate mortgage, it's always going to be about 900% higher than what you would pay on a variable. Okay, so that's the bet. You're basically betting that, you know what, 2 out of 3 times you'll break the mortgage and you will pay 9 times more, right? I'll give you a perfect example, Sam. Not long ago, I had a client come to me. They called me up. They did their mortgage at the branch, and they broke a $1.1 million mortgage, fixed rate mortgage, just literally about 12 months into the mortgage, and they ended up paying $84,000 in penalties. Okay, if they had gone variable, I mean, I get it, it's a big mortgage, it's $1.1 million, but if they had gone variable, that penalty would have looked closer to like $6,500, $7,500, and then there's $84,000, right? That's a massive difference in penalties. And you know, if you were to look at it, anybody that's on variable right now, anybody that might be regretting their decision, trust me, $84,000 is not even close to anything close to where the variable will be going in, you know, the next couple months. Okay, so I just want to make sure that, you know, everybody here is going to be okay and that you understand, you know, there's just way more to a mortgage than just rate.
So when you say too, like to touch on that point, it's not even close as what it will be in the next few months with variable. Are you referring to that the penalties will be a lot bigger for variable and for fixed? Is that
So
what you mean?
yeah, it will fluctuate, and it always will, because like I don't want to get into all the details and confuse people, but like big banks, they use what's called the post-it rate to determine penalties. Okay, and the post-it rate is way higher than what you have in contract. That's why the penalty is so significant, right? And I don't want, I just don't want to get into all the technicals and all the details, but all I'm saying is that yeah, I mean, it will fluctuate and it will always change. That's why whenever you go and check your mortgage online, you know, there's no magic number there that says, hey,
Yep.
guess what? If you break it today, this is what it will cost you. The banks want you calling them and finding out.
Yeah,
It's almost like they're keeping it a secret in a weird way, because yeah, I mean, you're not going to be a happy customer if every time you log in, check your mortgage and the penalty shows up.
yeah, I think to your point, it's interesting because you know, the stat of, I think it was like 70% of people breaking their mortgage within, you know, 3 years, right? So
Yep. We see
that's a
it
great
all the
example of
time.
a kind of a salesperson, you know, selling a mortgage versus a consultant, right? And helping them, you know, reach their goals and things like that. So that's a great example. We do have a question as well. How do investors keep qualifying for mortgages if they own so many properties? Don't the liabilities make it harder or more challenging to get a mortgage?
Absolutely. Good question. So this is why, you know, when you work with a mortgage broker who's got, you know, a lot of experience investing in real estate, knows how to place deals, this is where it's key. Okay. Um, because this is how you do it. So number one, we always try, obviously, with the best lenders we can until you get to the point where, you know, you're completely tapped out. Like, you know, your income just can't support buying another property. Then you know what we do? We start looking at different lenders. And this is what I mean by being a professional in a space where there's just so much access to different lenders who have different nuances. I'll give you a perfect example, right? You know, most banks, they're going to take 50% of their rental income. They'll add that to your income. And what they'll do is it'll increase your buying power. I've got other banks that use 80%. I've got other banks that will use 100% of the rents. It just depends where we go. And then once we get into subprime lending, it's like, hey, you know, they'll use 100%. I don't want to get too technical, but their gross debt service ratios, their total debt service ratios are completely different. There's different types of exceptions. And just back to my point earlier, this is what happens when you go to one bank and expect that they have all the answers. Is that, you know what, it's not their fault. That's the only products they know about. If it's a no, it's a no. With a mortgage broker, we just look at the whole picture and be like, hey man, how much do you want to buy? Let's get you there, and I'll show you how.
That's great. It's interesting because, you know, you find you can go to one mortgage broker, they'll give you one solution that may not be the whole picture. And then you go to yourself or someone that maybe understands it, the whole picture itself, and they'll be able to really help you with those goals. So I think that's really interesting you say that.
Absolutely.
So if you're, you know, planning to move or renovate, you know, what should you do now? What should you consider at this point? If you're a seller, you're a buyer looking for a bigger home, or you're downsizing, maybe, looking to right size your lifestyle.
Yeah, good question. So I always say, you know what, always be over prepared. And what I mean by that is literally get pre-approved, right? Get on a call with myself, Sam. I just want to get some more information, see what your goals are. Let's get you pre-approved. I'm a numbers guy, right? So at the end of the day, I love my numbers. And, I want to get you to the point where we can build out a budget sheet for you, a solution that says, hey, if you were to sell, based on the sale price that Sam gives me, we can work backwards, find out what your down payment's going to look like so that we can go and see what your purchase budget looks like, right? It's all about being overly prepared, especially you can agree with me, Sam, the market is hot, right? And, when you go by, you don't want to be like running around trying to get all your paperwork together, guessing, saying, hey, can I afford this or not? What are my monthly payments going to be? You're going to be way behind the pack. Any borrower that we work with is way in the front. They've got all their numbers in front of them and they're ready to rock and roll. Like they're going to beat out their competition. That's the best thing you can do is just get it all ready.
Yeah, I agree. It's almost like when you're driving somewhere, you have to have that map in front of you. And when we speak to sellers, we let them know, like, get ahead of other sellers, get things going first, talk to Sai or talk to a great mortgage broker, and then make sure that, when you're shopping for a home, you already have things in place when it comes to your numbers, what you can buy, and having a potential offer on your home, or at least having that process in place. So bridge, I guess, any other things you'd like to cover? If someone's moving, anything else they should consider? Bridge loans, different closing dates. Is there anything that you think that we should cover right now that we haven't?
Yeah, I mean, we can talk about bridge and all that as well, but I would say that one of the number one questions that I am getting very recently, Sam, is people deciding whether they should lock into a fix right now, especially with your variable. Like I said, more than half the population took variable in the last 2 years, right? And now they're kind of thinking, well, should I lock in? Like I said, I want you to consider a couple things. The statistics: 2 out of 3 people will break the mortgage. Okay, you're going to easily pay up to 4 to 7% of the balance, right? I've seen as high as 10% of the balance. Like I said, just depends where that posted rate moves with banks, right? And just some advice: when you do call your bank and you ask if you should lock in, I can guarantee you right now they're going to tell you, yeah, it's a great idea. You should definitely lock in. And do you know why? And I hope my friends at the bank don't hate me for this. But the reason why they tell you it's a great idea that you should lock in is because they know the statistics that 2 out of 3 of you will break, and their answer is tilted in favor of their shareholders. Like, you got to understand, banks are corporations. They are typically publicly traded anyways, right? They work for their shareholders, and the corporation's job is what? To make their shareholder profits. Okay. Now, full disclosure, I am on a variable rate mortgage myself on my own personal stuff. Okay. And just to put it out there, if you're not aware of this, there are variable rate mortgage products that don't fluctuate. Okay. It's got a static payment, but you will get the variable rate, which is cool. And you will pay the 3-month interest penalty and not that significant penalty. So if you will ever wanted to know about any of those products, like Sam said, my link to my calendar is in the chat, and we can definitely hook you up with one of those products as well if cash flow is a big concern of yours.
Excellent. So we're just going to open it up. If anybody has any other questions, feel free to put your hand up, type them in the chat. Let's see if there's anything else that we haven't covered at all. I think that's really great. Now, I know that with the future of the rates, can you tell us a little bit about what you're getting from the future of the rates, what that looks like, and how that's going to affect potential borrowers getting to the market, or at least people who are buying and selling?
Yeah, so I mean, from here, I can only see it going up. Okay, I mean, obviously we were at like rock bottom rates, inflation being super, super high, right? It's only necessary, in my true opinion, it's necessary. It's got to happen at some point. We don't want inflation getting way too ahead of us, because then that's just bad for everybody. It just means that everything is going to cost more, right? So yeah, I mean, I can see it going up from here, but I just want you to know that the news is out there to scare the heck out of people. That's the reality. Everything that you do with your mortgage if you're working with a good mortgage broker, they need to dollarize it for you, okay? Because somebody who has $1 million mortgage on variable is going to have a different impact than somebody who has a $200,000 mortgage, right? And so I just want to keep it simple. If you wanted to keep the numbers simple, you can you can keep in mind these numbers, right? The last rate increase, the Bank of Canada policy rate, right? It went up 0.5%. Okay, so that means everybody who's on variable, typically their rate is also going to go up 0.5%. To keep the number simple, what that did to the market is that every $100,000 that you borrow, okay, that's $25 a month, right? Not the end of the world, folks, right? It's just, when people see 0.5, oh my gosh, what does that mean? Or does that mean my rate's going to double? Or, my payments are going to double? No, it's $25 a month. If you wanted to break it down on a weekly basis, that's $5.75 or something like that a
So
week.
for every 100,000, it's $25
right.
a month.
Yeah.
Okay.
And that's on a 0.5. So if you hear on the news again that, hey, it went up 0.25, just chop those numbers in half, right? $100 is about 12, 13 bucks a month. And then, on a weekly basis, well, that's like $2.50, $3. So it just means that, what, you might not be able to buy that extra Starbucks this week, Sam.
Yeah, exactly. It's the way Starbucks have been for sure. And to your point about news, I think it's important to recognize that news is very generalized, right? So if someone asks
Right.
what's the temperature, it could be 10 degrees in Calgary or in Vancouver and -10 here. So to say that the temperature is 5 degrees, it's kind of a general statement. So that's really where the news doesn't get hyper local, I don't think, as well.
It reminds me of the time when we first entered into the pandemic, and it was like that first lockdown. Everybody's saying, "Hey, you know what? The real estate market is gonna tank. Like it's not a good time to buy." And hey, everybody that bought at that time, 2 years later, asked them if they ever felt sorry or
No,
bad,
no.
during the pandemic, because
Yeah,
everybody saw what prices did.
absolutely. The simple thing I always look at is, Toronto, more expensive market, immigration hub, still a month of inventory. If you look at that, you look at the 40-year history, we've had other things. There's still been a steady up and down, but still an increase overall.
Yeah.
And, you combine that with building equity, it definitely makes a lot of sense. The one stat I remember was from, I think, the last 30 years, real estate has gotten a certain percentage. I think it's 20 or 30% mortgage has been less than it was in like 1980s or whatever. And real estate has gone up by, 30, 40%. So it shows us that it's a good hedge against inflation is what I'm trying to attempting to say. So,
Absolutely. And to that point too, Sam, just want to add, whenever people ask me, Sam, hey, like, let's just throw the whole rate thing out of the whole picture right now. They're like, hey, Sai, how do I pay off my mortgage faster? My answer always is, Sam, it's just buy one more investment property. Okay. Like we have a whole webinar about this, right, Sam? If Sherwin, if you can put that in the chat box. Yeah, if you want to pay off your mortgage in 10 years, okay, or 15 years and half the time, that's all you need to do. Just buy one investment property, because I can guarantee you that if you sell that investment property 10, 15 years from now, and you take those proceeds, you can pretty much wipe out your mortgage instead of, doubling up on your payments and worrying about where rates are going and all that kind of stuff.
yeah.
Because we've done this before, right, Sam, where we've built out budgets for people where they can go buy an investment property and it looks like their life hasn't even changed because we've got some other tenant paying down that investment property. So cash flow wise, it almost looks the exact same on a monthly basis. It's
Yeah.
amazing.
Yeah. And you're right, because we've run the numbers on properties, and not to get into detail, but at the same time, it was just, if someone, it cost them like say $100 to keep that house, that extra
Right.
investment, with the pay down and only a 5% growth, if they got 30%, that means that they put 100,000 today, next year they got 130,000 in the bank. Where are you going to see that in, Bank of Canada, or they're offering $100 to open your account or whatever, right? So definitely a great point, and the reason real estate is great. So so I really appreciate you being on. It's been about 34 minutes. So if anybody has questions, please book a call with Sai. The webinar is in the link. We appreciate you jumping on, and trust you got some good value.
All right. Thank you, everybody. And thanks, Sam, for having me here.
Thanks so much. Take care.